let's unpack this. We have been handed quite a stack of material here.
Yeah, it really is.
And it perfectly captures, I think, the tension of 2024. You've got these, like, revolutionary micro possibilities, tiny digital assets colliding head-on with this massive, almost theatrical, late-cycle AI build-out.
Yeah.
And crucially, there's this layer of rising geopolitical instability underneath it all.
What's really fascinating looking through these sources is how they frame these two incredibly parallel worlds for us. It's almost like two separate realities.
Yeah.
On one side, you've got innovation measured in things like token burns, decentralized networks, community incentives, completely different metrics.
Right.
And then on the other side, the big picture, the macro picture is all about, historical fiat debasement, a fractioning credit market, old world kind of creaking.
So our mission today is really to dive deep into this material, connect those dots. We want to pull out the nuggets that show these flywheels the incumbents seem to be completely missing. We're linking the rise of tokenized infrastructure, those flashing warning signs in the macro environment, and these powerful geopolitical factors that are eroding trust to the old money systems.
And I think the perfect place to start is with what I found to be the most compelling opener in the sources. It's just this simple idea. Digital assets give you wings.
Okay.
Think about it. Today, the entire digital asset market, it sits at about $4 trillion.
Which sounds enormous.
It does, but globally, it's only about 1% of all financial assets.
Wow, only 1%.
Yeah, it's a rounding error in the eyes of big institutional finance right now. But, and this is the key, it's a rounding error with genuinely revolutionary possibilities packed inside.
Okay, that sets up this brilliant analogy the sources use. The Red Bull analogy.
Oh, yeah, that's a good one.
The sources point out, traditional drink giants. Look at Red Bull back in the day. They laughed at the taste, right? Dismissed the small, expensive can.
Totally misjudged it.
And completely missed the entire movement.
They missed it because Red Bull didn't really compete on the drink formula itself. It completely rewired distribution. It used culture, incentives, events.
Skipping the middleman.
Exactly. Skipped all the established middlemen, the bottling plants, the old networks. And that is the model for this new financial infrastructure layer being built right now. It's about bypassing the old rails.
That's the core idea.
Yeah.
Distribution through culture and incentive. So if we apply that thinking to technology, to physical infrastructure, that leads us straight to DePIN, right? Decentralized physical infrastructure networks.
Yes, precisely. This is where things get really interesting because you see users actually turning into the infrastructure builders themselves.
How does that work?
Well, the whole function of DePIN is to incentivize you, the individual, to deploy something physical, a sensor, a Wi-Fi router, maybe a camera.
Okay.
And for contributing that piece of hardware to the network, you get rewarded with the network's tokens. You're literally paid to help build the utility.
Right. And this is where it gets really interesting. When you look at the gap between how the market sees these things versus the reality on the ground, the sources highlight examples like Helium and HiveMapper.
Yeah, and the market often just sees these as, niche projects, maybe a bit experimental. They exist in what the sources call an alternate reality, far away from serious finance.
Well, the numbers tell a different story.
The data shows something else entirely. These networks are already, quote, serving 2 million plus U.S. phone subscribers, in Helium's case, and HiveMapper is mapping 36% of the world. That's not negligible scale.
36% of the world. Wow. So we're seeing what the material calls obsolescence by openness.
That's the term they use, yeah.
So how are companies like HiveMapper and GNet using this open incentive model, acting as these twin viruses, as they put it, eating away at the big centralized empires like Trimble and Mobileye?
Well, the contrast is incredibly stark. It really gets to the heart of how technology evolves, doesn't it? The older players, Trimble, Mobileye, they rely on these proprietary, very expensive LiDAR systems. The sources kind of dismiss them as science projects on wheels.
Oh, yeah?
They're closed systems, slow, vertically integrated. They need massive upfront capital investment just to get started.
Right, compared to, say, the approach Tesla took, pioneering the use of just cameras, cheap sensors, building that planetary AI loop.
Exactly. And you see that same kind of evolutionary leap playing out in the mapping space here. The difference between proprietary LiDAR and these distributed camera-based vision systems, it's profound.
Explain that difference, LiDAR versus vision.
Okay, so LiDAR, the sources compare it to walking with a stick. It helps you avoid bumping into the thing right in front of you, sure. But it doesn't really help you understand the environment dynamically. Vision, on the other hand, especially when you leverage machine learning on these huge data sets from all the users, that gives the network a brain. It understands context.
And the DePIN networks, like HiveMapper, they take that efficient vision-based idea and just turbocharge it by decentralizing the cost entirely.
That's the key. Instead of one company needing a fleet of super expensive mapping cars,
Right.
you have potentially millions of anonymous devices, dash cams, phones equipped with cheap sensors, all contributing data, building this global spatial graph that updates itself way faster than the legacy guys can even justify sending out an invoice.
So the takeaway is the death of the legacy systems won't be some big, dramatic collapse.
Probably not. It'll likely just be a quiet obsolescence. They'll just get ground out by the constant hum of decentralized mappers earning tokens while they drive to work. It's the Red Bull approach, but for data collection.
That shift from proprietary capital spending to incentivized open networks, it feels like a fundamental direction for tech.
Yeah.
Okay, so we've seen the revolution happening at this micro layer.
Yeah.
Now we have to pivot and look at the potentially crumbling foundation of the macro layer.
Yeah.
Because the sources are flashing some deep red lights, even with the stock market roaring.
Precisely. And we have to acknowledge this profound disconnect that's happening. You look at something like the USD Atlanta Fed GDP tracker. It's running hot, 3.8%, suggesting strong growth.
It looks good on paper.
Right. But then the sources point to state-by-state data that shows recession already happening in key sectors. So how do you square that circle? How does that rhyme with the NASDAQ and the S&P hitting highs together?
And the answer, according to one analyst quoted here, is that what we're seeing is pure late-cycle theater.
I love that phrase.
The sources argue, pretty convincingly I think, that the AI bubble is simply the old credit cycle in drag.
That captures it perfectly. It describes the current phase as the melt-up phase. AI capital expenditure, all that spending on GPUs and data centers. It's acting like the market's morphine drip.
Keeping things elevated.
Keeping the indices levitating through this final burst of euphoria, all powered by NVIDIA dreams, and, let's be honest, still quite a bit of lingering Fed liquidity sloshing around.
But hang on. Are we sure this isn't underestimating the actual industrial shift happening with AI? I mean, if AI really is the new electricity, shouldn't the market be rewarding that huge structural build-out? Why are the sources so insistent it's only credit theater?
That's a fair challenge, but I think the reason they lean into the credit cycle and drag idea is because underneath those big index returns, you see these significant credit fractures starting to open up.
Okay, like what?
Well, things that show the base economy is actually struggling while the top end thrives. We're seeing auto loan defaults creeping up, especially for subprime borrowers. That signals real consumer strain.
Right.
And the amount of leverage being used in private credit markets is described in the material as simply absurd.
Absurd leverage. That's never ended well historically, has it? So what happens when that underlying plumbing starts to leak or even fail?
Well, right now, everyone's kind of pretending the plumbing is fine. But the sources say commodities are acting as a truth serum.
Right.
Gold, copper, even oil. Despite some recent drops, they're reasserting their dominance as tangible assets. It's a signal that fiscal debasement, governments printing money, is running riot globally, and people are seeking real stuff.
And this underlying rot, this fragility, explains the theme the sources call thematic selectivity in the market.
Exactly. The prediction is pretty clear. Upcoming earnings might be a negative shocker for value stocks, the boring stuff, but a bloodbath is coming for specific sectors already showing weakness.
Which sectors are flashing red?
The material points to specific negative corrections that suggest money is already moving out of consumer-facing or financially exposed areas. You've got retail, the XRT US ETF, down 5%. Housing, XHB US, is in a 10% correction.
Wow, 10%.
Yeah, and even the financials, like the BKX or KRE indices, they're down about 3.5%. These aren't just random dips. They line up perfectly with worries about slowing consumer demand and rising credit risk.
Okay, so why should we care about these credit fractures if maybe we're just focused on the AI boom?
Because it directly drives the flight to tangible assets. And that flight is the necessary bridge to understanding the role of digital assets, too. You have to look at the huge gold surge. The sources call it the world's quiet vote of no confidence in fiat theater.
Quiet vote of no confidence.
Gold hitting, say, $4,000 an ounce is framed not just as a price target, but as a confession that the current financial system is fundamentally broken.
And this isn't new, is it? There are historical parallels.
Oh, yeah. The sources draw those lines explicitly. They mention Rome when its coins basically turned to dust, Spain when silver imports became poison, and more recently, America unilaterally tearing up the Bretton Woods Agreement in '71. It's a pattern.
And the core mechanism is always debasement, isn't it? America doesn't technically go broke in default by missing payments.
No, it simply debases slowly. It pays its debts, but with currency that buys less and less over time. The real risk isn't a sudden collapse. It's this slow grind of inflation, crowding out, and fiscal laziness.
As the source puts it, the U.S. effectively runs the casino and just prints the chips to keep the game going.
And that printing, that institutional erosion of trust, is what drives capital flight. You see it clearly in the de-dollarization discussion.
Right, Ken Griffin's comments.
Exactly. Ken Griffin voicing concern about substantial asset inflation away from the dollar as global players look to de-risk their portfolios vis-a-vis U.S. sovereign risk. The whole idea of fiat currency, given the enormous debt loads and entitlement promises behind it, it's being seriously questioned.
And as that trust evaporates, the panic, the flight capital, it now has two main options for safety, right? The sources say code as well as coin. This feels like the convergence point.
That's it, precisely. When you see the titans of traditional finance billionaires we all know, like Ken Griffin, Stan Druckenmiller, Paul Tudor Jones, when they publicly move long into both digital assets and gold,
it tells you something.
It tells you something brutally simple, as the source says. Bitcoin, in this specific context, isn't framed as some radical tech gamble. It's described simply as the pressure valve, responding to this deep institutional erosion of trust in governments and central banks.
Okay, before we really dig into the sheer scale of the AI build-out, we need to touch on some of the structural risks highlighted in the material, because they really reinforce this narrative of systems kind of fraying at the edges.
Absolutely. We have to pause on the UK working crisis data point. It's genuinely alarming for any major G7 nation.
What does it say?
The source details that 11 million working-age people in the UK don't work. That's 25%, a quarter of the entire working-age population.
1/4. That's staggering.
Now compare that to right after World War II, a time of immense national trauma. Only 2% of the working population then were deemed too sick to work, and that included people suffering from severe PTSD, people who had lost limbs.
2% versus 25% today.
Yeah. And the critical question the sources pose directly to you, the listener, is how long can a modern economy actually sustain that level of systemic dependence and fiscal laziness without eventually triggering a major crisis of confidence?
It feeds directly into that narrative of fiscal irresponsibility driving debasement, doesn't it?
It does. And you also see these tragic figures mentioned from the Ukraine conflict, which further underscore a different kind of institutional failure. The population has reportedly dropped from 52 million in 1991 to maybe just 20 million today.
A devastating human cost.
Absolutely. And yet, the sources note, some Ukrainian oligarchs are chilling in Monaco with billion-dollar yachts, even though Ukraine remains the poorest country in Europe. That level of internal corruption just fuels external distrust in the entire regional structure and the system supporting it.
And these facts, whether it's domestic structural issues in the UK or alleged institutional corruption in Ukraine, they circle back to why people like Ken Griffin worry about U.S. sovereign risk too, right?
Exactly. When core institutions, whether economic or political, fail to govern effectively and transparently, capital gets nervous. It seeks safety in tangible assets and, increasingly, in decentralized code that exists outside those traditional structures.
Okay, let's pivot back quickly to a couple of specific market notes before we get to the final AI debate. The sources highlight some fascinating disruption happening down in Latin America with Mercado Libre, MEI.
Yeah, MEI is really shaking things up. They're rapidly displacing the old guard down there. The stat that jumped out was they now control about 15% of the financial services market in Mexico.
15% already?
Yeah, and they're closing in fast on the biggest traditional bank there, BBVA. It's just disintermediation happening at lightning speed. It confirms that this incentive-driven, digital-first model works across very different markets.
Okay, and the second technical note was about a potential defense against this melt-up phase. We discussed specifically the structure of the WQW ETF.
Right. This is quite a clever structural play for investors feeling a bit nervous. The WEQW ETF tracks the familiar MSCI World Index, but it uses equal weighting within each sector country group.
Okay, why is that significant? Equal weighting.
It's important because it dramatically reduces the influence of the mega-cap tech giants that are currently driving so much of the market's overall return and its valuation.
So how does that impact a stock like, say, NVIDIA, which is huge in the normal index?
Well, NVIDIA's weighting in the standard MSCI World Index is a massive 5.4% roughly. But because of this equal weighting structure within its specific sector group, its weight in WEQW plummets to just 0.26%.
Huge difference. So it massively dilutes that concentration risk.
Precisely. And the result is you get exposure to the global economy, but with a lower overall forward price to earnings ratio, the WEQW is around 18x versus the standard MSCI World at about 20.1x.
So it offers a way to kind of bet on the world economy broadly without being totally dependent on just the top 5 tech names continuing this, frankly, hyperbolic rise.
Exactly. You could see it as the prudent investor's way of acknowledging the melt-up might continue while simultaneously hedging against those credit fractures and concentration risks we talked about earlier. It diversifies away from the very top.
Okay, let's bring it all home. We finished with the core debate that really ties everything together. Is this AI boom purely a bubble destined to pop? Or is it something different and inevitable, state-backed, industrial build-out? We hear the GOMs, right? The grumpy old men.
Yeah.
Constantly sneering about AI bubbles, lack of valuation discipline.
And the counter-argument presented in these sources is incredibly powerful, I think. It argues, look, this isn't just another market trade. This is officially industrial policy.
Meaning governments have decided this is critical infrastructure.
Yes. Washington, Riyadh, Abu Dhabi, the major sovereign capital centers of the world have effectively decided that AI is the new electricity, full stop.
And when governments decide something is the new electricity, they stop asking about PE multiples, don't they?
They absolutely do. They just pour concrete, lay cables, and buy every GPU they can get their hands on, almost regardless of the short-term cost. It becomes a strategic imperative.
And this massive spending, it fundamentally changes the market dynamic because it essentially funds itself, right? It creates this powerful feedback loop.
That's the key insight. Each big chip order justifies another data center tender, which leads to another power contract signing, which encourages another sovereign AI fund to be launched. The capital flows become circular and self-justifying. It builds its own momentum.
This is where the sources bring in that famous 1840s railroad analogy.
Yeah, a classic. People at the time screamed that the rail barons were laying track to nowhere, that the valuations were completely insane, detached from reality.
But 10 years later...
10 years later, the railroads essentially were the economy. They ran everything. The argument is this AI infrastructure build-out will continue, regardless of cost, until the foundational layer is complete.
Okay, but what's the consequence of this industrial policy, this massive pouring of concrete, largely funded by debt and government subsidy?
It exacerbates the exact problem we talked about earlier in Section 3. It debases the denominator. It weakens the currency.
So the currency itself stops being a reliable store of value and starts becoming just a coupon for participation in this new AI-driven industrial reality.
That's the framing. And the next few months, the sources suggest, are when the concrete gets poured in earnest. That spending is the engine driving both the AI stock melt-up and the flight from traditional fiat currency.
And you even see the circularity, the self-reinforcing loop in specific deals mentioned, like the AMD OpenAI arrangement.
Yeah, described as this clever loop of mutual validation where confidence effectively acts as the collateral and hype becomes the currency. They inflate each other's value by recycling this narrative of inevitability.
Wow. Okay, so just to recap, we've mapped this new digital asset layer using the Red Bull analogy. We've warned about the credit cycle's late-stage theater, the AI in drag concept.
Right.
We charted the flight away from fiat driven by these deep structural failures and lack of trust globally.
Yeah.
And then we looked at how massive state-backed industrial policy is funding the AI future, almost irrespective of traditional valuation metrics. It's a remarkable framework of tension.
I think the core takeaway is this growing, almost undeniable gap between traditional valuation discipline on one hand and sheer strategic necessity on the other, meaning you almost have to own what's real tangible assets like gold or copper, energy infrastructure, maybe these decentralized networks we discussed. The world seems to be betting against the traditional bond market, watching them, as one source vividly put it, dance hard near the fire exit.
While the U.S. continues to run the casino and print the chips.
Exactly. That's the dynamic.
So we noted that this huge AI build-out, funded by debt and subsidy, ultimately debases the denominator, the currency.
Right.
But we also looked at that WQW ETF, the equal weight strategy designed to significantly reduce the influence of hypervalued leaders like NVIDIA. So here's the final provocative thought for you, the listener. to explore on your own. What does the potential popularity of a strategy like equal weighting imply about genuine investor confidence? Are investors confident in the specific market leaders carrying the load right now, or is it more about hedging bets on the overall health of the world economy? Put differently, are we truly betting on the whole index anymore, or is this just a final, somewhat desperate bet concentrated on the top 5 names? Something to mull over.
Disclaimer. North Breach Limited, Nutstuff trading name, is an appointed representative of Messels Limited, which is authorized and regulated by the Financial Conduct Authority. Nutstuff has made every reasonable effort to ensure the information provided in this communication is correct, but Nutstuff makes no representation nor any warranty as to whether the information is accurate, complete, or up to date. To the extent permitted by law, Nutstuff accepts no responsibility for any errors or misstatements, negligent or otherwise. Nutstuff, its associates, officers, or employees may also have interests in the financial instruments referred to in this information by acting in various roles. The information in this media is confidential. If you are not the intended recipient, you are not authorized to use the information in this media in any way. Nutstuff does not guarantee the integrity of any media or attached files. The view or opinions expressed are the author's own and may not reflect the view or opinions of Nutstuff. Electronic communications carried within the Nutstuff system may be monitored.